Your bank account is lying to you. By the end of this year, that growing balance you check every week could cost you everything. We are trained to seek the comfort of a traditional fixed deposit. You log in, see a reliable 4 or 5% return, and feel secure as the numbers on the screen climb. But May 2026 inflation data reveals a different reality. While the line representing your nominal balance goes up, the line representing your purchasing power is in a free fall. This is a psychological trap. A higher number on a statement creates a false sense of security, while your actual ability to buy real-world goods shrinks every single day. This chart tracks essential commodities over 24 months against a standard bank yield. When layered over today's prices, the shortfall is obvious. The interest earned fails to cover the increased costs, leaving you with less than you started with. Keeping capital in these traditional accounts is a strategy for guaranteed loss. You are trading your future value for a nominal profit that cannot keep pace with the market. The math is clear. The banking system has ceased to be a safe haven for middle-class wealth. To understand why this is happening now, we have to look past the temporary price spikes of the early 2020s. This chart illustrates our transition to structural inflation. Unlike a temporary spike, this represents a permanent rise in the baseline cost of living. The drivers are permanent. Supply chain taxes and the energy transition have created a new, higher floor for prices. Corporations are passing these costs directly to the consumer, which means every dollar you earn buys less today than it did yesterday. The old rules of money are broken because the economic landscape they were built for no longer exists. Financial institutions recognize this pivot, yet they continue to keep consumer deposit rates at an artificially low level. This creates a widening gap. Banks pay a stagnant yield while aggressively raising rates they charge for loans, maximizing their margins at your expense. Then, the government subtracts tax from your nominal interest, ignoring your real-world loss. You are paying capital gains taxes on a real-world loss. This creates a massive negative yield that effectively drains your portfolio. This entire system facilitates a silent transfer of wealth from individual savers to the institutions that issue debt. The 2026 pivot has reversed our understanding of safety. What used to be considered conservative is now high risk. Holding a cash-heavy position in a fixed deposit is the most dangerous move for long-term wealth. The safe vault is a place where value corrodes. Financial success now depends on the ability to buy goods tomorrow, regardless of the nominal balance today. Investors must prioritize the actual utility of their capital over the total number of units in the account. Long-term survival in this decade requires looking past the illusion of the bank statement to focus on preserving real-world purchasing power. Escaping this trap requires moving into instruments specifically designed to track the current rate of devaluation. This framework involves moving capital into real-yield assets, things like inflation-protected bonds or commodities that have a historical track record of rising alongside these structural costs. By owning the very things that are becoming more expensive, your capital stays ahead of the inflation line. Take a hard look at your current portfolio. Every dollar sitting in a fixed deposit is a dollar that is losing its future value by design. We are approaching the next quarterly shift. You must identify these vectors of guaranteed loss and move toward assets that offer real growth before your purchasing power erodes.